All right. Good morning, everybody. Hello. Thanks for joining us today for what I'm sure will be a great discussion about how COVID-19 has affected the Charlotte real estate market. And thanks especially to our panelists. We have Cynthia Hegler, Stephen Overcash, Jay Rawls, and Claire Bennett, who I will ask to introduce themselves here in 1 minute. Specifically today, we're going to focus on how COVID-19 has impacted the way that all of us in Charlotte are living, how we're working, and how we expect travel to happen in the future to our city. I am Trent Hawthorne. I'm the moderator for today's session. I'm the Chief Operating Officer at Rabbu. And if you don't know about Rabbu, we are a platform for earning real estate investors more yield. We do that through the short-term rental market. So think Airbnb and VRBO and Booking.com. If you give us a real estate investment property, then we will do everything soup to nuts, including managing your guests, getting you listed on all those platforms. And we also build proprietary technology to do that at scale. COVID-19 has impacted our business in a very big way. A couple examples for you. Normally, we're in the business of hosting out-of-town guests to Charlotte for weekend stays, and typically those stays are 3-night stays from Thursday to Sunday. Obviously, this is not a normal environment during COVID-19, and when travel came to a standstill, our business was very impacted, and we've gotten basically new types of reservations in the last 2 months, which are longer stays. So our normal average night stay went from 3 to 23, so 3 days to 3 weeks. We've also seen an impact to our average daily rates. In a normal environment, an average night is $150 typically for our units, and that's been cut in half to about 75. So you can see that it's obviously drastically changed our business, and basically overnight we became a midterm manager instead of a short-term manager. So we were seeing how that impacted our business and caused us to wonder what else is happening in Charlotte's real estate market. And what does the future hold? And so we wanted to gather the panelists today and have a great discussion about that. So that's enough about me and Rabbu. I do want to get to the panelists, and I'm going to ask the panelists to introduce themselves and talk about their firm a little bit, and also give us a high-level view of how businesses have been impacted from their perspective in the last couple months. And I'm going to start with Cynthia Hegler. Cynthia is the owner of Southern Home Group. So Cynthia, I'll turn it over to you.
Hi, yes, I'm Cynthia Hegler with Southern Home Group, as you already said. So our firm deals exclusively with investors in all different ways, flips, new construction, property management, short, long-term, buy and holds, pretty much anything investors, that is what we do. Our business is very interesting because before the COVID-19, we were experiencing what we called a stall. We're really having trouble having people sell their houses because they were scared to go spend a lot of money on a new house. So we really slowed down, and then when COVID-19 hit, we went to a stop because nobody would come out and see properties anymore. But now, during COVID-19, once they lifted all of the restrictions, the realtors got back to work. We have an unprecedented busy season going on right now. We've talked to several realtors, have tons of listings, tons of buyers, tons of action the past 2 weeks. We've really come back to life. So some of the biggest changes that we've experienced, and I'm sure are here to stay, is our open house procedures. So we were locked out of doing open houses for about 6 weeks. So we have our first open house next week. We see realtors putting in hand washing stations and trying to find Clorox wipes and masks. And we really cut down how many people we can have. So that has turned all of our marketing almost exclusively digital. So before we did a lot of print media, planning people to come in, meet, network, and now we have to get professional videography, big digital campaigns so that we can get a ton of people on the property to see it before they ever walk in it. So that's how it's changing for us, and I'm sure that it'll continue on like that even after this, that people have an expectation for that going forward, which is exciting and fun. So
That's great. Thanks, Cynthia. I appreciate that context. That's awesome. Let's go next to Jay Rawls. So Jay is a director of multifamily at My Niche Apartments, which is a division of Lat Purser here in town. Jay, I'll turn it over to you.
Sure. Thanks, Trent. So like Trent said, I run operations for our apartment division, My Niche Apartments, and we are the multifamily division of LPA, and we we are a full service commercial real estate firm. Um, and my role in our apartment division is handling operations for properties, apartments, townhomes um, that we self develop and manage, and also assets that we manage for others. We manage for about half of our business is third party management, and half is for assets that we develop. I'm also involved in the development process um, as well, and in underwriting deals and helping source deals for us. And as an apartment operator, we've seen a tremendous number of changes. I think the first few weeks were the worst. We had to sort of scramble to make these changes. We were not very prepared for. I think that was just a general thing in the industry. We've closed. We started out by closing a lot of amenity spaces. We tried to keep them open for as long as we could. And then, we had to come to terms with residents really just being at home every day, versus being at work. Where we work, where a lot of our property managers and leasing consultants and maintenance folks work is home for so many people. So we're just, they're seeing in many cases our staff for the first time ever. Our staff seeing residents for the first time ever. They're at work and our staff's there, and now it's kind of unique. But we kind of then started to implement a series of questions. Whenever work orders are submitted, our maintenance teams, went to just doing emergency work orders only. So they weren't entering occupied units. And despite that, we saw an increase suddenly of, just general work orders being submitted because people are at home. And, I think they're just noticing things and thinking of things more so than when they're not at home every day. We started, of course, increased cleaning protocol, elevators, door handles, as became the case everywhere, I think. But and then we had to come to terms with a drop in our leasing traffic, which, as of last month, I think I looked at the end of April, March and April, new leases were down about 60% over last year. But lease renewals were up about 80%, which was encouraging. So we've been offering a lot of early renewal specials, just trying to get that sort of foresight. Instead of offering lease renewals for 90 days out, we're offering for 120, 150, 180. Just kind of getting ahead of it, so we kind of have this foresight and we know what kind of vacancy exposure we're looking at on our stabilized properties here. In the next 6 months versus just knowing what's going to happen 2 months out. And we really, as an industry, I think in the apartment side, had to make a quick shift over to virtual leasing. And, we had a lot of 360 tours. We had some video content, but we had to gather that, try to make it more prominent on our property websites, and make it more obvious for prospects visiting our websites. We had experimented on a few properties with self-touring, where a prospect can just let themselves into a unit and take a tour themselves without a leasing consultant. We've done that on a few properties. We then had to roll it out in 3 states where we operate, in both Carolinas and Georgia, and put these Z-Wave lock boxes on properties so that we could offer the self-tour option. So that's really been a challenge, but we've kind of gotten past that, and now we have those up on our websites. We're getting traction, and I think we've kind of become a bit used to that now, in the multifamily side. But It's all been, it hit us kind of like a big truck all of a sudden, I'll say. But we've adapted and we're still leasing. We've leased throughout all of this, and I think the folks who were able to kind of easily pivot and were familiar with some of these virtual leasing platforms and chatbots have been able to adapt better than others.
That's great perspective, Jay. It's really cool to see a lot of the operational and technological changes that people are adopting so quickly. And I think a lot of them are here to stay. I'm sure we'll get into some of that. Let's go next to Claire Bennett. Claire is a brokerage associate at Foundry Commercial. Claire.
Thanks, Trent. Good morning, guys. My name is Claire Bennett, as Trent said, and I work with Foundry Commercial's Office Tenant Advisory Group. And so while we like LAPFIRS are a full service commercial real estate firm, my role specifically is I work with tenants exclusively and work with them side by side to help them understand how their corporate real estate, specifically their office space, plays into their broader strategy. And then we'll work with that group to help them not only find, but we'll negotiate and build out that office space. Because the commercial real estate industry lags the general economy by anywhere from 6 to 9 months, the biggest impact we've seen is just a slowing of deals and active deals specifically. But the biggest disruption is the question and the uncertainty of what's the office space going to look like, not only in a week or two when everyone is fully transitioned back to work, but what does office space look like in a year and 3 years and 5 years? And that conversation spans from capital investments to the physical build out and the architecture of the space to how much space a group is taking on. But that's where I've been focusing a lot of my time, is helping clients, both prospective and current, prepare for that transition.
That's really cool. And you mentioned architecture, which is a good segue to our next panelist. Stephen Overcash is the principal at ODA Architecture. Stephen, could you tell us a little bit about yourself and your firm and the effects you've seen?
Thanks, Trent. We've been around for quite a while. Like Trent said, I'm Stephen Overcash with ODA Architecture. Started the company in '84. Have always been into commercial, very little residential. We got into about 20 years ago, unfortunately, or maybe fortunately, in the hospitality industry, and we love it, and it's a lot of fun, and it got way too high on our workload. Last year was 60% people building hotels. We work all over the East, and every time we pick the phone up, somebody needed a hotel. We couldn't hire people fast enough to help us out. All of that obviously came to a screeching halt on March the 17th when I started getting calls, and we had literally had $3.5 million worth of fees put on hold within about 3 weeks. So it was tough. The ones that kept going are the hotels that did get calls were the larger projects, high rises, maybe in Nashville or somewhere that they knew that they weren't going to be opening until 2022, 2023. So they figured at that point things are going to be better, but everything that was a smaller hotel that was going to be opening anytime in the next year or two just came to a screeching halt. And so we're working with the hospitality group. We started a task force to study ways that we can make cleaner hotels that are healthier after COVID. And we set up a task force, and it's sort of a system sort of similar to LEAD. And we're working with all the hospitality clients. Some things cost very little money, some things cost more money, but let them decide how healthy of a guest experience do they want to have. And that's where we are today.
That's great. And totally understand on the side of things coming to a standstill, just to give some more context too on what happened at Rabbu around the exact same timeline that you mentioned, Stephen, which I think you said March 17th. So in mid-March, most of our bookings come from Airbnb, and Airbnb made the decision, which we think was the right decision, to designate its stays in most areas under its extenuating circumstances policy, which essentially gives guests full ability to cancel their reservation, and it overrides the host's cancellation policy, no matter what it is, whether it's strict or flexible. The guest has the entire power to cancel the reservation. And obviously we book many of our stays in the future, and we saw about 100% of our bookings evaporate overnight. So our portfolio went from very booked to almost completely wide open. And the stays that remained, we expected to be canceled. They just hadn't been canceled yet. So we were staring at a calendar that had some reservations that we knew were unlikely to fulfill, but we're still in the middle of our calendar. So we had some decisions to make about what do we do? Do we automatically or go out and actually proactively cancel those reservations and open our calendars up for longer term stays? Or what do we do? So we found ourselves in a similar situation in mid-March. I know a lot of businesses are dealing with similar things right now. I do want to talk a little bit about the residential side, specifically the investor perspective. And Cynthia, I want to ask you on that front. Home sales are down year over year. There are certain statistics out that say that home sales are down about 30% year over year during this period. But interestingly, prices are actually up. So kind of wanted to get your perspective on that. Do you expect, what do you make of those fluctuations, and what do you see happening from here?
Well, not only are home prices up, but our inventory's down. So historically, whenever we have a housing market crash, we have a surplus of housing inventory. Whereas right now we have like less than 2 months. I think the statistics vary between Gaston County and Mecklenburg County, but we're somewhere between 1.5 to 1.8 months of inventory, which means we are still in a seller's market. And because of the lack of inventory, it's driving the prices up. So the sales being down last month, I 100% say that's just because Mecklenburg County restricted showing. So for 30 days, we could not show houses. The only deals that could continue were the ones that had already started and had money riding on them. So we've heard, some banks like Chase banks made it harder to, they made your credit score have to be 700 and you have to put down more of a down payment, but that's not what we're saying from all banks. It's just one bank. A lot of people work with Movement Mortgage. They haven't changed at all. So there are many people that have lost their job, that have not lost their jobs, that only got furloughed, that are still getting paid, and they're still buyers in our market. As soon as Mecklenburg County lifted their restrictions, our summer season started. It was really interesting because our season should have started last month, and it was like it got halted. And now all the realtors I've spoken to can barely keep up. They went from having their worst month ever to having their historical best month ever, which is the same thing that our whole entire firm's experiencing. 7 agents. I went from having 2 or 3 listings last month that were vacant lots that have been sitting on market forever to right now I think I have 15 listings and 4 more coming active next week. We put a property active in Mecklenburg County last weekend, right when they lifted the restrictions, and we had 25 showings in 48 hours. I think there were 5 or 6 offers on that property. So the numbers to me show what we were hopeful about the whole time, that our deals slowed for a few weeks. Our inventory is still low, our prices are still rising, and buyers are still ready to buy in our market.
Yeah, that's super interesting. It's almost like an open the floodgates type scenario.
Yes.
We have demand right now. Let's talk even further out, right? So, obviously there's been huge hits to GDP, and that's expected to continue with unemployment skyrocketing like it has. As Claire alluded to, the real estate market typically lags the stock market and the general economy. As you look out, after this period of the pent up demand sort of wanes, look out to the rest of the year, do you think that we'll see home prices go down in our market, or do you think that there's something about the Charlotte market that makes it a little bit recession proof, if you will?
So I've talked with this about I've talked to many people about this. I mean, we're all guessing at this point because it's so crazy, but it's my opinion that the unemployment numbers are very skewed. I mean, we have people that are furloughed that are on unemployment. They haven't lost their jobs. They're just not working right now. And then we also have a lot of people that are on unemployment just because their business isn't going. They would not otherwise be on unemployment. So I've heard a lot of numbers this week, the worst unemployment since the Great Depression, Well, we totally changed who could be on unemployment and who can't. I mean, there's a lot of realtors that are on unemployment that had they truly lost their jobs, they wouldn't even have the option to be on unemployment because they're contractors, they're contract employees. So it's hard to look at those unemployment numbers and think that that's good data to judge the future by. I'm hopeful and I believe that once we get over this lockdown, everybody's going to go back to work. We already didn't have enough houses. We still don't have enough houses. And I think we'll be thriving again. My biggest concern is going back into a lockdown in the winter. So I don't know. It's really hard to know if we will find techniques or vaccines that'll prevent that from happening, or if it'll be worse the second time. I just don't know enough about science and politics to have any idea what that would look like. I think if we come off a lockdown, if we find ways to keep each other healthy, we get back to work, I think we're fine. Outlook worse in the next year if we don't figure that out and we end up in a worse situation in October and November.
Gotcha. Yeah, that's great perspective. We, like you, we have no idea what the future holds really as it relates to the virus and how that's going to be reacted to from the government standpoint and everything else. One thing we've been doing at Rabbu to try to proactively get ready for investors to want to buy properties, and specifically properties that are specifically suited for short-term rentals, is that we've been building a lot of proprietary data tools that allow investors to find high yielding properties in certain geographic areas. In fact, just this week, we added to our website a tab that you can find at the top of rabbu.com that has what we're calling insights. And you can basically drag and drop a square onto a map and it'll produce yields for properties that are on the market as they relate to short-term rentals. So we're really trying to give investors the tools that, if it does become a buyer's market from a seller's market where it is now, that investors can take advantage of that and go that route. But that's
the one issue we'll have with that I am seeing is that our hard money lenders, our fix and flip lenders, are still lending at 90%, but the rates went from 9% to 3.5%. I think I just put a flip under contract myself this week. The big problem is our investors the banks are not wanting to lend on rental property. So we do the BRRR method a lot, where we go fix something, flip it, have it appraised, and then cash out refi it to turn it into a rental. And they're not doing cash out refinances for rentals. So we're forced to sell instead of take on another buy and hold. Hopefully that would ease throughout the summer as the markets improve. But if we cannot get loans to buy rentals, that'll make investors, it'll make us harder to buy later in the year rental property.
Yeah, and to piggyback on that, Cynthia, I think we've seen the same thing in multifamily. It's like we had several deals in the pipeline, and we need to get construction loans to get these deals in our development pipeline to get them off the ground. And in some cases, all we were waiting on was the debt piece. And we had, a dozen banks after some of these 200 unit, multifamily apartment buildings, back in January and February. And then suddenly it was like no one, they said, well, it could be a month, could be 2 months, we're just not lending right now. So like the project, the terms may change a little bit. They're just taking a wait and see approach. They don't know what cap rates they're going to do. They don't know what the supply chain is going to be like and what construction costs are going to look like. So it's just, they're just taking this wait and see approach. I think some of them may have come out of that just a little bit at this point, but we still have deals that are just at a standstill from a development standpoint, just purely based on the lenders.
Yeah. And I have lenders that used to do 75% loan to value that are now going to 60% loan to value. So what they're really doing is they're just cutting down on our liquidity. I mean, we're still going to do the deals, the best deals, But when we have, 15% more equity tied up in a project, what it does is stop us from doing 5 projects at a time. Now we're doing 3 projects at a time. So, which is surprising to me. All the property managers I've spoken to and myself, we have 100% of our rent in. It has been late. Usually we get our rent by the 5th. We've been getting our rent 100% by the 15th. I've talked to some other big single family residential property managers, and they are still getting their rent at normal levels. So hopefully the banks will start loosening up and lending on our rental properties again.
Yeah, that's great perspective from both of you about the financing market, which is obviously hugely important. Jay, I do want to ask you a question about going forward, how you think the virus might impact the spaces, right, in multifamily. So do you think that developers are going to change the way they model communities related to social distancing, or do you think that not much will change?
Yeah, I mean, we've already had some discussions about this, and internally and with some other groups. I think that I do think the townhome product, units with private entry, we'll see an increased demand for that type of product. And I think, if you look at like a mid-rise apartment product, I think there'll be maybe more of an attraction towards a boutique building, with 30, 40, 60, 80 units versus 300. You're sharing an elevator, you're sharing amenity spaces and all that with so many fewer people. There's a lot of speculation that there will be more movement to the suburbs, so it could make suburban development sites a little bit more attractive. There's been this influx into the urban core for so long, and that's not only in the Charlottes, the Raleighs, the Atlantas. It's been, in a lot of our secondary markets as well. Where we've gone in and we've done, urban apartment product in some of these secondary tertiary markets in the urban core, because people, for the first time are wanting to live in these urban cores now. So there's some speculation there. It's a little early to tell, but I think that there's probably going to be a demand for more work from home space. People are talking about some damage to the co-living type of projects. We haven't started seeing those really in the Carolinas yet, but there are some larger cities where these co-living projects have really taken off. So I'll be interested to see how that kind of plays out. Are there going to be, is there going to be less of an attraction to micro units and more to larger units potentially? And then the last thing I've heard is work from home space. Is there was already this kind of growing popularity with developers for this work from home space, and kind of working that into community. A lot of apartment operators, management companies have been trying to figure out how to operate this co-work space. Do we operate it ourselves? Do we lease to a co-working tenant so we can offer that in our building as an amenity? There was already this shift towards that. So I feel like, there's going to be more of an attraction to units with balconies, units with these outdoor patios kind of off the common areas, and then work from home space. I think there's going to be this shift to that, and with that, is there maybe a shift towards a more of a focus on internet speeds. We've contracted with Spectrum and some of these other providers to provide the fastest speeds, and to bring fiber in. Is that going to be more of a priority for developers? So those are just some of the things that I've heard on just at this early stage.
Yeah, it's great.
Trent,
and mention
to piggyback off.
Go ahead.
Oh, sorry, Trent.
Go ahead, Cara. Go ahead.
To piggyback off Jay, we've had similar conversations, but with very different end results. So I think the transition away from the urban core, we would definitely expect at least a little bit. The co-working, co-living conversation is very interesting. So over the last year or two, co-working in itself has been at least 20% of all absorption, which in an industry like commercial real estate, that's huge. And so we don't see co-working going away by any means, but the idea of shared space or hot desks, so whether you're in co-working or in your own company's office, that hot desk hoteling, because of all the interactions people are having, that is going to be much less ideal. So we don't expect people to go fully back to the 80s and back to private office. But even in the short weeks since this has transpired, what we have seen is people don't really want to share an office anymore, or certainly not a seat. That they really want to have their own space, and they want to be able 6 feet apart. That'll affect density and affect layout, which we can talk about later. But the co-working piece will be an interesting shift. And also, to Jay's point, the working from home shift is another interesting question, which has certainly been taking up a lot of my time recently.
Yeah.
Sorry, go ahead.
I'd like to hear more on that point, because, just yesterday, Twitter announced that they're going to allow their entire workforce to work from home indefinitely, as long as they want. If it's something they want, they'll support it. And obviously, Silicon Valley tech firms tend to lead the charge on how people work in a lot of ways. Claire, what do you think the impacts of that kind of a statement from a company like Twitter will have on businesses in Charlotte? What's different about Charlotte as opposed to some of the more progressive areas like Silicon Valley, or what's the same?
No, that's a great question. And so I think working from home is certainly not going to go away. That trend will increase. Working from home is a very broad term, though. So I believe 70% of people before COVID-19 said they had some flexibility to work from home, but whether that was a few hours, a day a week, or they're fully remote 100% of the time, that looks very differently. And so one of the things we expect is for companies' policies to be a little more flexible as far as working from home, or jobs that are able to work from home, maybe they do it 1 day a week or something like that. What we're a little hesitant, that a lot of other people are saying is true, that we're a little hesitant about, is now that we've been forced to work from home, we're all going to do it all the time. And I just don't see that happening. It'll also impact what office spaces look like. And so because people don't want to do the hot desks or hoteling anymore, but you are going to have some more people working from home, at least in some instances, I wouldn't say full time, that now groups who needed 10, 20,000 square feet, now they need an extra at least 10% because of the density. The restrictions right now, parking and building density in your lease is normally about 4 per thousand, with Uptown being a little more dense. And then you see groups really having flexibility about their occupancy and kind of cramming people in at up to 8 per thousand. So we're going to see that decrease a lot, which means at the end of the day, groups, not only office users, but retailers and especially restaurants, are going to have to take additional space to then give their employees the additional space they need. So that's a really interesting trend that we're aware of, and it could tilt either way, but I wouldn't say, when things turn back on, everyone's going to be all home all the time.
Yeah, it's great perspective. Actually, not something I thought about, that companies will actually lease more space in certain cases to accommodate. Stephen, given that you're an architect, I'd like to bring you into that conversation about spaces, and specifically, I love your perspective about the hospitality industry, since it makes up such a good portion of your book of business. Do you think hotels will change the way they design spaces going forward? Are you having conversations with clients about that, or what do you see?
We're absolutely do. We're taking the lead on that for a lot of them. We're going to be having more nano walls where lobbies can open up to outside courtyards for more distancing. Fresh air is back to more operable windows. We won't be cramming everybody around a bar. That bar for 21 is now going to be a bar for 15 probably now. We're going to see more automation, people checking in on their telephones, not touching things, working everything from a telephone. Once you get in your hotel room, you can turn the temperature up, you can turn the TV on from your cell phone. Automatically, when they restart, now they're going to, all that junk you saw on your countertop, your free pad and the pen that you always stole to take with you, is no longer going to be there. We're going to see more UV lighting, which kills germs. From an architectural standpoint, we're going to be looking at more ventilation, more natural light. Natural light kills germs. I think the bigger groups will have robotics, where they bring in their robot to help do cleaning. We've already looking into self-cleaning rooms. 2 of them rolled out last year in Copenhagen. And there's different coatings that can go on counters that repel bacteria more. I think the buffet with the plastic eggs in the lobby is probably going away. Probably more pre-prepared meals, grab and go in a bag, or bring it to your table. Like restaurants, salt and pepper shakers, ketchup, all that'll be off the tables. I'm excited. I think it's because it's going to force developers who are always like dollar driven. A few years ago, everybody got into spending a little bit more money to make their buildings more energy efficient with the LEED and all that, and that was good. But you were just chasing a minuscule dollar amount to reducing your air conditioning. Now with office space and hotels, everybody knows that good ventilation, natural light makes people more productive. If you spend your time and your money on helping your employees be more productive, that's way more than saving a few dollars on electricity every month. So all these kind of things are, I'm excited. I think it's going to force us to create healthier buildings. We know how to get rid of these sick buildings where Legionnaire's disease and all that happens, and horrible things. So as architects and developers, it's a brave new world. It's an exciting new world to see what it's going to look like. And now it's going to be a little bit easier sell. Okay, this is going to cost you a little bit more, but you want your guests, you want your office employees to be healthier. And what we've done with the energy is we've kept everything so tight. We had to get, let's tighten up our buildings. We don't dare want any air to escape. But what that's done, it's made the inside air worse than the outside air. So office buildings always tell me in hotels, oh, let's don't do operable windows. People may leave it open. We may lose a few dollars worth of air conditioning. But I think in the big picture now, we're going to go back to more fresh air, more ventilation, and more sunshine. Bring the outside in. That's my 2 cents.
Yeah, that's awesome perspective. One of the viewpoints that we have at Rabbu is that COVID-19 hasn't necessarily changed anything about the future as much as it's accelerated the future forward. A lot of the trends that were already in place are already happening. Were just now brought to the now, right? So as an example, for us at Rabbu, we've been building proprietary technology for years now to help our guests check into our units without ever having to talk to anybody, right? So it's all automated. They can check in using the last 4 digits of their phone number on the programmable smart lock that we built software to do. So we're excited to see those changes in hospitality like you are, and it's great that ODA is a leader there, and that's an exciting future, I think. I do want to kind of shift back to a little bit of a roundtable as well on a couple of questions before we open it up to some Q&A from our attendees. I'd like for each of you to answer, and I'll kind of call you out in roundtable fashion. How do you see the next year playing out in your area of expertise? And also based on that, what advice would you offer to investors or stakeholders in your sector? And I think I'll go in a reverse order this time, and I'll go back to Stephen.
Sorry, explain again exactly the question you just had, Trent. I sort of missed the intent.
Sure. How you see the next year or so playing out in your area of expertise, and what advice you would offer, investors or stakeholders who might have an interest in that.
Good. Well, we're excited about Cynthia's news a while ago about how your industry is booming. We feel pretty optimistic. If you look at what China's done, China pulled out of this thing quicker than others because they went in earlier, and they've seen 35 or 40 pretty quick. So we're optimistic that after November, after the election, after we get on top of some vaccines, that we're going to be back. I honestly believe that most of the projects that were paused are good projects and are paused, not dead. But developers are they're cautious. They're sort of in this wait and see. We know second quarter is going to be bad. We hope to see bright spots in third quarter, and we hope to have a pretty doggone good 2021 because of people are just tired of they're ready to get back to it, and they'll figure that time their projects won't be opening until 2023, and they're gonna be optimistic. So I've noticed a lot of optimism with all the hoteliers. They're not down and depressed. They're learning and taking some time and getting ready for the next wave.
That's great. And I also mentioned to the attendees, if you are on the line and want to pose a question, then feel free in your Zoom app to add a question to the Q&A category, and we'll try to get to it here in a few minutes. Let's go to Claire next.
So the interesting thing about the commercial space is because we lag anywhere from 6 to 12 months behind, my next year is really going to be playing catch up. And so currently, from a deal cycle perspective now, what we've seen is that our deals that were either in leases or very close to it, those have closed. They hit a little bit of a snag with different construction or commencement timeline issues, but those were able to close. Anything before that really hit pause and just said, you know, we don't want to think about future space right now. We certainly don't want to talk about expanding. We'll come back to you in a month. And so that's all well and good. So a lot of this next year for me is going to be restarting those conversations with groups who are already in the market. That work will probably double because with the construction delays and then the broader supply chain delays, projects that would usually have taken anywhere from 9 to 12 months, we're looking at least a year, maybe 18 months to start. And so for groups who are maybe 2 years out on a lease expiration, we would highly encourage you to start that process, knowing it's going to take a little more time, especially as touring starts back up. But with lawyers and contractors tied up in other things, that process is going to take more time than usual. And so that would be one piece of advice as far as moving forward, that ping someone, make sure you're represented. We'd love to represent you, but just make sure you're represented by someone in the industry and talk about that timeline, whether or not you're 2 years out, you're 5 years out, put it on your radar, and so that it doesn't catch you by surprise and you're not losing any leverage or negotiating power with some of the timing delays that we've seen.
Awesome. Interesting stuff. Thanks. Jay, you're up next.
So the way I kind of envision the next year is kind of two perspectives. First perspective is on the development front, right? As a developer, we've already seen delays related to the supply chain. There's been a shortage of labor and a supply shortage. A lot of supplies that we get, China, Italy, Brazil, India, there are just delays. And, a lot of that's related to labor and factories, capacity being down. So I think, we've got a project about an hour and a half from Charlotte where, like our amenity space, our main building is now, instead of delivering in October, is now pushed out to February just because of those types of delays. So I think a lot of the projects in the pipeline, we'll continue to see those, and I think those will just kind of push everything out a little bit. Another thing kind of on that same development note is, like Uptown Charlotte, for example, South End Charlotte, that area, Uptown South End area has been one of the strongest apartment markets in the country for several years. You've got Charlotte, you've got Austin, Texas. The nature of that, right, has produced a 2020 where we were expected to see 10,000 units deliver just in Charlotte proper. So that's 10,000, apartment units that are supposed to be dumped on the city. Maybe some of them are delayed because of, supply chain or labor, inspection issues maybe. but that's a lot of units to a market where, there's still inventory that hasn't absorbed left over from 19, right? So you couple that with, the slowdown in leasing traffic that we've seen over the past couple months, and maybe, a little while before things kind of pick back up, those markets that already had an overabundance of supply, I think it's really going to take longer for that supply to absorb. And I think that could impact rents. I've seen some NMHC studies that are predicting no rent growth, some markets with negative rent growth this year, just because of that inventory, that supply, taking longer to absorb now. It'll sit for a little bit longer. People won't be moving. In a lot of cases, they're going to stay put. So that'll be interesting. We're looking at a record year. I think it was up like 42%, 2019 to 20 in Charlotte in terms of apartment deliveries, right? I don't think we're going to continue to see that into 2021, 2022. So you've got to kind of wonder about some of the stuff kind of the groups had in the development pipeline. Is that still going to materialize? Maybe. And then, I look at it separately, the apartment operations front, right? And on the operations front, thankfully, we haven't seen an impact yet on the collection side. We're still collecting rent. Retail, is getting clobbered. That part of our, that division of our company, is looking at hundreds of tenant rent relief requests from restaurant and retail tenants. And, they're trying to defer rent as much as possible. And it's a struggle in those little unanchored centers in particular, where you got a bunch of mom and pops. And I think we're already seeing deals in our pipeline where we had, ground floor retail in a residential building that was, 6,000, 7,000 square feet. Now it's being, reduced down to 3,000, 2,000 square feet. We're just going to have one retail tenant because we can't justify the construction cost, doesn't justify the rent we can expect on those ground floor retail spaces. So I think, there's been this sort of idea that, and a lot of it's been dictated by the municipalities. We want mixed use. We want retail in our residential buildings. We don't just want apartments. Well, I can't build retail if the rents are, going to be $10 a foot. People have to spread out. Restaurants can't make money at 50% capacity. So I think, it'll be interesting to see how that goes. The municipality is going to now say, okay, you can make it look like ground floor retail and just put your gym down there and maybe some work from home space, and maybe that'll suffice. But I think it's yet to be seen. Will we see a delinquency, a collections issue? Will tenants, really struggle to pay rent over the next few months? It's really tough to say. We had a really good April and May. All the studies I've seen, and our data has been consistent, where April and May collections in multifamily were on par with where they were this time last year, which is great. So, people are paying their rent. They want to keep their homes. I think it's just people are terrified right now. And I think the money that they do have, the stimulus money they're getting, I imagine they're spending it on rent, which is good. We were worried that may not be the case. So hopefully that, collections don't become an issue in June, July. I think, someone mentioned, that it takes a while for some of the effects to play out. And I think that'll be the case. But, the lease ups we have, I think we do have to expect a slightly shorter lease up time frame. Still people really, valuing the virtual touring, people seem to really embrace the 360 touring, just more social media presence. We're trying to engage more with our residents in different ways. We're trying to have food trucks come to the property, do virtual resident events. How can we engage with our residents, without having resident functions on our properties? And so I think you'll see some creativity there, and then a continuation of what I mentioned before in terms of the shift in trends.
Yeah, that's great stuff. Thanks for that. Cynthia, how about you? What do you think of the next year?
I think for my investor clients, if they're not cash buyers, they're going to be flippers in new construction. because of the lending piece of this, they're going to be forced to do fix and flips. I just put a house under contract this week and I'm forced to fix and flip it. So I think we'll have more fix and flips. I think our marketing is going to totally change. You know, we get out there by doing things such as door knocking and meeting with people. And I think we're really going to go to ringless voicemail systems, text message systems. When we market our flips, we are going to be Facebook, Instagram, just like we're already doing hiring videographers, which is a different element to me because that's not something I've ever dealt with before, being creative. And the more videos I make, the more I realize that I have to come up with something different or they all look the same. It's just a different house. So I think it's really gonna push us when we're not working in our business to be working on our business, to be finding more lender options, finding more private money options, you know, tightening our numbers, making decisions on how liquid we do and don't want to stay. I mean, me personally, I've really probably tested my limits more than I should because I've been really comfortable flipping and renting in this market. You know, you're wanting to stay more liquid now and the banks are wanting you to put down more down payments. So that those dynamics will change, make us get tighter on our numbers. I think that we have a lot of opportunity. Before now, we were going to buy houses directly from owner occupants who thought their house was worth $200,000 because their neighbor's house sold for $200,000, but their house needed $50,000 worth of work. And it was very hard to educate those people because they couldn't see past what their neighbor had made. You know, now that this is hit, we are seeing more motivated sellers, more reasonable sellers, more negotiable sellers. I think that gives our investors a ton of opportunity to make good deals where the deals were really far and few between when we were coming up to this because sellers had such high expectations.
That makes sense. Well, great. Well, appreciate everybody's answer on that. You know, we at Rabbu, we're starting to see a few green shoots on the short-term rental market returning. As we talked about at the beginning, we mostly manage properties in Charlotte, but we do have units in Savannah, Georgia, which is obviously a drive to vacation market. And we're seeing some bookings now start to come in that are 2 and 3 night normal weekend bookings, which we haven't seen in a couple of months. So that's starting to bounce back. Obviously the drive to markets are the key there because air travel's down 95%. It's essentially totally dead at the moment. So we do see the vacation markets coming back that are drive to primarily, and urban markets may be a bit slower. But this midterm demand has been really interesting over the past couple of months. And it seems like there's more midterm demand than really anybody was previously giving attention to. There's a lot of people that are traveling to Charlotte for a new job and they're building a house, or they want to figure out what neighborhood they want to live in. And they would rather live in a 2 or 3 month furnished unit while they figure that out. And that's been really interesting for us. That kind of COVID has forced us to find that demand, and we found it, which has been interesting. So we've actually been about 90% occupied throughout the entire coronavirus period, which is highly unusual for us. Normally we're around 60 to 65% occupied, but at higher rates. So we see some of that continuing for the next year. We do have a question from the audience that I think, Cynthia, probably you're the best person to answer. We have a question of, when do you think the best time will be to buy and hold an investment rental property? So what are your thoughts there?
I think that if you are a cash buyer, now is a great time. I mean, we were really struggling in Gastonia. A rental property I would buy 2 years ago for $35,000 is now all of a sudden $55,000. And of course, the rent has increased too. You know, we were renting those out for $650 and now we're getting $850 on them per month in rent. If you're a cash buyer and you are buying cash, I think right now is a great time. There are tons of people with vacant properties have just been sitting there that they haven't thought much about, and now they're at home and they're having to pay taxes. They want to move them. So now's a great time. If you have to use hard money, if you're using the BRRR method, when you analyze your deals, you can still do it. But when I'm analyzing paying interest, I am analyzing 9 months of interest instead of 3 to 6 months of interest. So as long as you put those payments into your budget and you make sure that you can survive not being able to cash out refinance in 9 months, then you can still do it now. Yeah, so I'd say if you're a cash buyer, go now. If you're using lending, you might want to wait another month or two to see what the banks are doing, and also be prepared for a change in the banking in October if we get locked down again.
Awesome, thanks. We have a question I think would be interesting also for Stephen to answer. What might be different about this recession that we're heading into than previous ones? And since ODA has been around since the mid '80s, Stephen, you've been through a few cycles. What are your thoughts?
Been through a bunch of them. Early '80s, the early '90s, dot-com bust, the last one. This one it's far different. Usually you see the recession coming, you got plenty of time to unload, get rid of some dead wood in the office, and start slowing down over a year. And I had predicted the end of this year we were going to start seeing a recession. And then this thing hit in March. It's going to be much quicker because everything went out so quickly that it's not going to hang on for 2 or 3 years like the last one, or most of them, last a couple of years. This one is far different. Just like Cynthia said, her people are already back out there. I think all the other sectors are going to follow suit. And I think America's entrepreneurial, Charlotte's entrepreneurial. We're going to band together and pull out of this thing. And I'm thinking that in about a year, we're not going to be back to where we were in 2019. That was a record year, but we will certainly be back in good shape. And that's the biggest difference is it's not going to drag on for 2 years.
Great. Appreciate that perspective. We are about at the hour mark, and I like ending on an optimistic note, which is good. So I think we can go ahead and probably wrap up here, but I do want to thank all of our panelists again, Cynthia, Claire, Jay, and Stephen. Thanks so much for your time and your great insights. I know the audience enjoyed it. I definitely did. I learned a lot personally. So really appreciate you guys' time. I hope everybody has a great weekend in Charlotte and everybody stays safe, and we can all get together soon when things are normal again. But you guys have a great Friday, and thank you so much.